Okay, good morning, good afternoon, good evening. Thank you for attending. My name is Brian Kahn, and I will be speaking to you tonight about our Q2 in review and the Q3 look ahead. It could be also a preview. I guess it could also be a hypothesis or maybe our theories going forward as far as what the markets have in store. So we'll go and bounce as usual from the PowerPoint slides into the markets. So the next slide here, I'm just going to leave this up for a few seconds so you can read it. It is our disclaimer, and just be reminded that this is for educational purposes only. There are absolutely no buy, hold, or sell recommendations. And as I always like to note, you are trading leveraged products when you are using foreign currencies, so trading plans are obviously very, very important because you know that over-leveraging your account and trading without a plan can be deadly in a very, very short amount of time with the different volatility and different rumors and different things happening in the market. So this disclaimer should be kind of a warning sign to you, no matter what market you're trading, no matter what your trading strategy is, that you should be aware of the risks and you should trade accordingly. So our outline for tonight is going to be our Q2 in review. We'll do a fundamental review and then a technical review looking at the markets, major trends, major areas of support, major area of resistance, and then we'll kind of go into a preview, and I'll kind of preview what I think is going to happen with fundamental analysis. Obviously, that's just my opinion, so I don't think that I know what's going to happen. I'm just talking about some scenarios that could happen, and it's kind of like a flow chart. It'll be if this and this happen, I'm going to be doing this. If that happens, I might be doing that. So I'm flexible. I'm just thinking about these things, but obviously anything could change my mind, and I can adapt as a trader. I can adapt as an investor, and that's key for you guys to understand that I want you to be astute. No matter if you're a long-term trader or a short-term trader, you can always change your mind. Every single day is a new day. Use your fundamental analysis. Use your technical analysis to follow the markets and let the markets kind of dictate what we do, how often we trade, when we enter, how to move our stops and manage the trades, when we're going to exit, when we're going to switch and go from being long a currency maybe to being short a currency. So I think that astute is a good word to describe what I'd like you guys to, how I'd like you guys to be approaching the markets. Also flexible and adapting to the markets, I think, is a good way to approach the markets. So we'll kind of leave it to an open discussion, and I'll let you guys maybe even ask as many questions as you want. I'll try and answer them. You know, other pressing issues that you guys are preparing for as traders going into this next quarter. Hopefully it will be a successful quarter for everyone, the summer months, and you'll approach it in the right way. Your opportunity, I'll talk a little bit about that and how I work with individuals, and then we'll just show the review slide. So let's just talk about the fundamentals going on over the past 3 months, the past 12 weeks or so. So broad themes. What I'm seeing is that the U.S. data, the economic data that we're getting, has really, really weakened over the past 12 months. I'm sorry, past 12 weeks. Really, really weakened. And remember, the world likes to look at the United States, all right? It's very rare to have the United States doing very well and other countries doing poorly, or other countries doing really well and the U.S. doing poorly. For the most part, they're watching the U.S. as the leader in the economic markets. And so over the recent 12 weeks, the recent quarter, there has definitely been kind of a lull in that economic data where it's starting to come in under expectations. Just also remember, as a trader, most of your volume in the Forex markets goes through at the European close, the U.S. open. That's when the markets are really, really busy. There are other busy periods, obviously, depending on what currencies you're trading, but that's the bulk of the volume, and obviously a lot of that volume goes through on some of the major pairs that are compared with the United States dollar. What's going on in reaction to that economic news that kind of we have to keep in hindsight. Why do we keep it in hindsight? Because there's things going on behind the scenes that are even bigger than that economic data. That's the accommodative policy. If you paid attention to the recent Fed statement that I've written about in my daily market commentaries, if you're paying attention to what's going on in Europe, and even talk about what's going on over in Japan and the Far East and China, all of these governments and all these central banks are intervening and working together in these coordinated central bank efforts. So the question for you is, what is it doing to the markets? Is it working? Well, as far as I'm concerned, when we look at the technicals, it's working. It's working for the equity markets, and that's keeping the equity markets buoyed, and it's keeping them at an elevated level, and thus that's keeping volatility low. So we'll talk about volatility as well. So right there, the S&P, the broad measure of the United States equity markets, is barely off its bull run highs, barely off its highs, well within striking distance of its bull run highs. And if economic data continues to suffer, the question is, how bad does that economic data have to be to get governments to intervene, to get quantitative easing 3, Operation Twist to continue, whatever you want to call it. And if that happens based on past performance, that's not a guarantee of future performance, but just looking in the past, the equity markets have gone up. Maybe this time the economic data is so bad that the Federal Reserve decides to do quantitative easing and it doesn't work.Maybe it's a negative for the economy. So that's why every single day is a new day. We have to approach the markets. There are no guarantees out there. Just because something did something in the past doesn't mean it has to do it in the future. So we just have to play it according to, at that moment, if there is a QE3, you have to decide where prices are and what that means for you as a trader. So those coordinated central bank efforts, I don't think they're ending. I don't think any of this rumorville is going to happen, even though, as I will show you, volatility is low. Volatility is acting higher than the levels are actually telling us, because anything can happen at any time, and I call that rumorville. And it's very, very, very nerve-wracking to be a trader and do all of your due diligence and make a trading plan. Then all of a sudden an announcement comes out that you have no control over, that no one expected, and the markets run. So that's why stops are important. That's why trading the correct size. So it's hard for me to write anything. It's hard for me to talk about anything, even if it's a specific technical indicator, without throwing in that trading psychology. I've been trading for almost 15 years now, all different markets, all different strategies, all different time frames, all different economic cycles, and trading psychology is what it's all about. You being mentally fit as a trader is the hardest thing to stay consistent, and that's where traders blow up or they lose all of their account. But if you stay disciplined, which again is hard to do, if you stay disciplined, then it's hard to blow up your account if you play by the rules. And that's so very important, not to become emotional, not to become attached to any one trade or any one of your analysis. You have to be flexible, be astute, be able to adapt. So get used to it. Get used to these markets where anything can happen anytime, and just adjust your trading size for this surprise trading environment. Technically, what's going on in the major pairs, and if you want to look at some other pairs, I can bring those up. I have some of those typed in. I might not have all of them, but we're going to look at the majors for the most part. We might bring up some others, and then obviously I'll do some of that intermarket relationship, as I always do, and I'll actually do that starting out with the equity markets and talking about that volatility. So let's go in here into, I'll pause as I switch programs here, and I'll make sure that I pause and try and answer questions back and forth. So we're going to go into, in fact, you know what? When I was bringing this up, I forgot to bring up the IBFX MetaTrader 4 platform. So I'm going to start that right now. So just bear with me, and we'll get that started. Okay, perfect. All right, but before we go there, like I said, I like to do the intermarket relationships. So I have to pause a little bit because I have the panel here for the webinar kind of in part of the screen where I like to see some of the price action and some of the X and Y axis, so I have to move that out of the way. But again, as I'm switching from program to program, from equity markets to Forex markets, back into the PowerPoint slides, please reach out with questions. That's what I said on the email that went out, is this is a good time to answer your questions, because we're kind of talking on a pretty macro level. We're not talking about one specific indicator today, so we can talk about some other things. So please type those questions in. So what I wanted to do is I wanted to, before I go into the markets, show you where I get my fundamental news. This Forex Factory page is free, and it's linked right from IBFX's website, so you can get there. And again, what I've been following over the past quarter is economic data has been weakening. Today, we did get a pretty big number of durable goods, and it came in right there above expectations. The core, which has some things related to energy, and it came in down a little bit. But again, this I kind of expected this to happen because the data in durable goods has been so bad the past 3 months that finally they lowered the expectations of it because it's been so bad, and then finally came in above expectations a bit. But again, the trend has been down. All right, we're not just looking at one number today that came in above expectations. The trend as of the past few weeks, past few months, has been down. Almost every single economic data event for the United States has been coming in below expectations. And you know that we have to pay attention to the big number, the jobs number. And right here, we get weekly jobs data in the form of unemployment claims. This trend has been trending up. More and more people have been filing for first-time unemployment help. That's been trending up, and we're only a week away from the major data that we get once a month. We'll be getting the June data in July. It's usually the first Friday of the month. So if you go to July here, and you look at the first week, and you go down to the first Friday of the month, right here, the employment rate, and then the employment change, how many jobs were created. So we've been creating less and less jobs over the past few months. We drastically underperformed last month. Is that going to continue? And if so, what does that do to the guys in the Capitol that want to get reelected? Is that enough for them to push the button on QE? If the numbers get bad enough, it might not be a negative event for the equity markets. It could be a positive because they go, oh, the government's going to step in and bail us out. So that's what's interesting about trading now. You have to play it both ways. You have to understand what's happening both ways because bad news can sometimes be good for the economy. So what are the traders doing with this recent bad batch of news? Well, we go here to look at the S&P. So I'm just going to type in the broad measure of the U.S. equity markets. This is the ETF on the index. So the index is actually just a multiple of 10. So it'd be 1330 roughly instead of 133. But what I wanted you to notice again is we've had a recent bad batch of data over the past few months. And I'll scroll down here a little bit so that you can see. And the markets have rolled off over the past few months, okay? And then we started to go sideways and we came back up. And we actually had a pretty nice bounce, percentage-wise, 126 or 127 down here, all the way up to about 134, 135. That was about an 8% move up. We got that 8% move up as data was coming in, underperforming, and the markets are rallying. So we're very close within reach of the bull run highs, which are up about 142, which would be 1420 in the index. Just to give you some perspective, here were the markets back in 2007 and 8 when they fell off from their high, and here's what we've done over the past 3 years. And so this is the past 3 years. We're going up in 2009, up in 2010, sideways in 2011, up early 2012, and then we rolled off. So what I mean is we're very, very close to our bull run highs. Bad economic data isn't really shaking us off our highs that much. In hindsight, looking now back at the previous volatility, and it's fun to do it on a yearly time frame. If you remember back last summer was when Europe was burning in the streets and Greece and they're rioting and everything like that. Well, things haven't really changed over in Europe, and things haven't gotten that much better over in Europe, but this is last summer in Europe when the S&P is down at 105, 110, 115, and this is this summer and we're up at 130 and 135. So things must be better in Europe, things must be better around the world than last year because the markets are higher. What does that do to? Yes, over the past year, some economic data has been better. Over the past few months, economic data has gotten worse, but over the last year, it might be a little bit better in some areas around the world. Obviously, a lot of it might be attributed to central bank coordinated efforts and things like that. I'm big on VIX. I'm big on the volatility telling me what to do, how frequently to trade, how large of size to trade. So this is a mirror image of the markets here. So last summer, the markets were low. Last summer, volatility was high. The markets rallied. The volatility dropped. The markets over the past few months have started to drop a little bit. Volatility has risen a little bit. Just over the past couple of weeks, the markets have rallied, and in June, the volatility dipped back down. So volatility is an opportunity gauge. It's also known as a fear gauge, but think of it as opportunity. The higher it is, the more movement there is. The lower it is, the less movement there is, and probably smaller trading ranges. So it should affect how often you're trading. If the volatility is lower, I'm prepared to trade every day, and I may very well trade on a daily basis, but I don't expect to be trading on a daily basis. When volatility is up in the 40s, I'm pretty much thinking that I'll probably get multiple trades per day as a day trader. So that's just something to kind of let the markets dictate what you do. Don't force the markets to react to you. You react to the markets. And just to give you a hindsight, because some of you are regulars, some of you are new, I use foreign currencies every day to trade. I also use foreign currencies to hedge an equity account, so not hedging within Forex markets, but I use it to hedge equity markets because I'm an equity trader, I'm an option trader, I manage portfolios, and so I use these intermarket relationships to take off risk, if you will, if I'm heavy in a position in commodities, and I use the Australian dollar as a hedge because I understand that relationship, or just equities as a whole, because there are relationships between equity markets going one way and the US dollar going another way, and I write about that in my daily market commentary on a daily basis, those relationships. So I think you should be a well-rounded trader by understanding all of these different markets, even if you're just a foreign currency short-term trader. You've got to know what's going on around the world with economic calendar, with these central bank announcements, and with other markets such as the equity markets. So be a well-rounded trader. I think it'll lead to good trading edges as well. And a lot of you know that IBFX is now partnered with TradeStation, which is a very, very good equity and options platform. So you guys can get your charts for the equity markets from the TradeStation platform there. So that's a look at the equity markets. They're doing very, very well. What does that mean for Forex markets? We'll take a look at it. So let's roll into the Forex markets. We're going to run through the majors on a large time frame, on kind of a larger scale, just to see. All right, and I'm just going to check back once in a while when I'm switching these platforms to see if there are any questions or anything like that. So again, please feel free to type in questions at any time. So let's go out to a daily chart just to see what's going on. Remember, we're kind of focusing on this recent quarter, but let's take a look and just get some, this is about a year. We're going from last July to this July. Remember, a recent bad batch of economic data came through in the last quarter, April, May, and June. The pound, for the most part, had been going up, 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 up early in this year. Here's January, February, March, and April, all right? And the equity markets were going up at that point. Equity markets topped out basically around May 1st, and here you have May 1st, and what is the pound doing? It's dropping and dropping and dropping and dropping. Over the past couple weeks, even though economic data is bad, the equity markets have rallied. What has the pound done over the past few weeks? It's rallied. All right, these are big moves. 1.63 on down to 1.53 roughly, so 10 pennies down, 1,000 pips, and then it moved up, as you can see from the Fibonacci here, right to about the 50% range. So equity markets down, pound down. Equity markets up, pound up. Then the equity markets sold off over the past couple of days and kind of now are starting to go sideways and back up, and you had the pound sell off. So they are matching each other pretty well here. Let's look at the euro in the same time frame. Here you are, May 1st. Equity markets roll off, euro rolls off. We know the euro is in a big downtrend. We know things are going on, specific to that region. That's what we'll talk about for our hypothesis going forward. But the euro is definitely down at its recent lows, 1.22, 1.23, 1.24, down there hanging out. I actually wrote an article about maybe a potential dead cat bounce. If equity markets suffer and go down, will the euro get dragged through its lows and go down? Okay. Rolling into one of our commodity currencies, the Australian dollar, that's related to that currency over in Australia, that economy, they export a lot of gold, a lot of commodities. So as commodities started to come down earlier than last quarter, the Australian dollar started to suffer. The Australian dollar started to go down, not in May, but in March and April. And then when we had our severe crash in the equity markets in May, then you saw the Australian dollar really tank again in May. And then all of a sudden, things started to recover over the past couple weeks. And you saw through the first part of June that the Australian dollar recovered and had a nice retracement up here to about the 61 percent, 62% area. So again, these intermarket relationships, what's going on with equity markets? Well, now you can see a pretty good relationship with the United States dollar getting stronger and stronger and stronger as the Aussie dollar goes 110, 105, 102, parity down to 99, 98 below parity, starting to roll down. So that's a big move. 110 to 95-ish, that's 15 pennies. That's 1,500 pips, and then it bounced up back above parity, and now we're rolling around here. Just a similar currency over there, or kind of not a similar economy, but similar region of the world. Obviously, New Zealand doesn't have the huge exports in the commodities that Australia has. I think they definitely have a lot of, probably a lot of sheep. That's what they have down in New Zealand. So as we rolled off, again, they were more sideways in that early part of this year as we went into March, April, and then May, and then again, then you saw them really, really crash in May, just like the Australia dollar did, just like the other currencies did, and then again start to rebound, and they actually had a larger correction. They rebounded up to the 76% mark versus the Australia dollar didn't roll up as much, so maybe that just has to do with New Zealand not being as tied to a commodity crunch where countries don't need that commodity as much. I've heard from a friend who works in the mining industry that there are barges full of coal sitting off the coast of China, and China said, we ordered these, we're not taking delivery of them, we're not paying, we don't need them, our stockpiles are full. So there's just was a recent slowdown in the need for these resources, and so that's what you have to be paying attention to. A lot of you may have equity accounts and 401ks, you may work for companies in this sector, and so that's the kind of intermarket relationships that you can use and say, hey, I know that China has a thirst for this commodity. They are now saying they've got major issues and they don't need it as much. What's that going to do to that commodity? That commodity price, because there's more demand now and less supply, should go down. Anything dealing with that, any stocks in that sector or the ETF representing that should go down. Hey, I'm heavy in that because I own that, I work for that company, my futures invest in their stock. That's the kind of stuff that you should be doing in this economy, is paying attention to these intermarket relationships and be willing to maybe put on what we call is a hedge. There are no free lunches. Your hedge could lose money and your portfolio could lose value. There are no free lunches. There are no guarantees, but at least you can see some of these relationships as we started to see the global quench for these commodities, this global thirst, start to slow down and start to subside, and what it did to equity prices and what it did to foreign currencies against the dollar. Moving into another commodity currency, the US dollar Canadian, on the daily time frame, what did it do in May? The United States dollar climbed and climbed and climbed and climbed. What did oil prices do? 105, 100, 95, 90, 85, 80, 80, 75, hanging around 75, 80, 75, 80. So we're right in this area. We're kind of going sideways. Pretty tight range here. That's the other thing to remember. What is volatility doing? Volatility is creeping up, but it's still very, very low. What are these ranges doing? 101.50 to 103. That's 150 pips, and we've been in that range for almost a month now. You have to be very good to understanding, hey, that's a pretty tight range, 150 pips, because that's 150 pips in 24 hours per day. You don't trade 24 hours per day. You trade 3 hours a day, 5 hours a day, 6 hours a day, 7 hours a day, whatever it is. You have to understand that it's a 150 pip range. Where are you going to trade it? Are you going to trade it in the middle of the range? Are you going to trade it at the top of the range? Are you going to trade it at the top of the bottom of the range? So again, volatility is somewhat lower. Let that drive you. You can't ask the Canadian dollar for 200 or 300 pips per day because it's not giving you 200 or 300 pips per day. As an intraday trader, you can't ask it for 80 or 100 pips because you're basically asking for the entire trading range while you're watching it in your 3, 4, 5 hour span. You have to be realistic. The United States dollar against the Swissy, again, the United States dollar did climb against this one in May, and then like most others in June, backed off just a bit. All right, so that's our macro view of what are the traders doing with this news, equity market-wise, volatility-wise, and then against the majors. All right, I'm going to bounce back into the slides here, and if you have any questions, again, please make sure to use the questions functions where you can type them in. The only way that I can see them is if you actually type them into the questions function, so please make sure that you are doing that. All right, let's slide back into the presentation here. Oops, sometimes I hit there's two down here and I hit the wrong one. All right, so technical review of quarter two 2012. I think we saw some major moves there, some good action if you're looking at it on the long term and even obviously on the short term scale. But that was just the long term setup. Now the quarter three fundamental preview, also known as my theory or my hypothesis. And I put there, I know, everyone wants to hear about the euro because everyone wants to trade the euro. We'll talk about that. I have a question for you. Who knows what's going to happen? Do any of you know what's going to happen? I don't. All I know is the euro is still there. It's still a functioning currency. I can still trade it. You can still trade it. But we obviously have to look at the technical analysis to do it. So as far as we're concerned, it's going to be volatile. It's going to be fun. There's going to be events. Let's trade it. Let's trade it well with good trading plans. There's going to be opportunity. That opportunity doesn't mean profit. That opportunity means I think there'll be enough movement for you to create trading plans, and then you have to manage them and manage your entries and your exits and the management of the trade. I think there'll be continued government intervention, whatever you want to call it, QE, Operation Twist, austerity, liquidity measures, whatever it is. I think that these governments are going to be forced to do it because I think that the economic data is going to continue to maybe get worse, but definitely go sideways. I just don't think it's going to improve. So keep your eye on ongoing economic data. Use that link from IBFX out to the Forex Factory page and use that to pay attention to it on a daily basis. The other thing, chasing performance. What does chasing performance mean? Remember, I'm not just a Forex trader. I manage portfolios in the equity markets, and I use options to do different types of strategies depending on what I want to achieve with that strategy and what I'm trying to do with an equity portfolio. So think about it. Can you get good rates of return to keep up with inflation in the bond markets? Absolutely not. Maybe in Australia where you're getting very good interest rates, but nowhere else. Where do you need to put your money? Is it going to be in real estate? Is it going to be in private ventures? Maybe. There's this new thing called crowdfunding that you can get into if you want to, but a little bit scary if you know anything about investing in private ventures, so be careful there. So the bottom line is I think that the markets can still provide investors and traders with good returns if they know how to understand charting, if they understand where good opportunities are in trading plans and how to manage it. I'm not saying you invest in buy and hold and just turn your eye on any market that you're entering. I want you to build a trading plan around it and have a trading plan from entry to exit and manage it all the way through. But the bottom line is people are forced to continue to invest in the equity markets because that's the only place that they're getting good dividends on dividend-paying stocks, and they're getting good return. The returns in the equity markets in the past have been very good, and as long as economic data doesn't drop off a cliff and as long as the Federal Reserve and the central banks are involved, then hopefully the equity markets continue to do well and we don't have all doom and gloom out there. I'm not doom and gloom. I'm not pessimistic. I'm just realistic. But again, if you're an investor for the long term, where will you find value? Are you finding it in bonds that give you 2% over 10 years, or are you finding it in good quality companies in the equity market that has been rallying over the past few years? So chasing performance, as long as that's the case and the best value for people and the best return is in equity markets, if equity markets continue to climb because people are forced to put money in it and they think that's the best place to put it, that might continue to drop volatility. So what I mean by chasing performance, if equity markets get buoyed by whatever reasons and go up, that might drive volatility down. And for you short-term traders and scalpers and swing traders, you just have to know that that drives your frequency of your trading, and it might be a little bit slower or it might take longer to get into your trading plan and execute it, and it might take a little bit longer to get out of the trade because obviously in lower volatility markets, as I explained, trading ranges are smaller and the volume going through every day might be a little bit smaller, and just the opportunities, the swings might be a little bit less. So if equity markets continue to be the place to be, what does that mean for you as a trader in a lower volatility market? If for some reason people say, I don't want to be in the equity markets, and they sell off, that means volatility should go up, and that means opportunities should go up. Markets will be more volatile. You better watch what you're doing and have trading plans, but that could lead to more opportunities, oversold, overbought, oversold, overbought, and more opportunities throughout the day, throughout the week, throughout the month, whatever your trading plan is. So that is my fundamental preview. Is I'm somewhat bullish the equity markets just because that's where people are getting their good value. That's what they've been seeing rise and rise and rise. And until that changes, until that underlying bid provided by the central banks goes away, that's where people have been putting their money. But we've got to watch economic data. We've got to listen to the Federal Reserve. We've got to listen to the ECB and the Bank of England, because if they decide not to help us out, that could change things, and that could change people's investments decisions in the equity markets. All right. Technical preview. Again, I know the Euro USD, people want to talk about it, so I've been writing about it in my opportunities in it in the daily market commentary. I'll show you the link all week kind of in preparation for that, so make sure you're reading about that. So before we get into my preview of all of those majors that we looked at, just think about it. Based on fundamentals, all regions of the world are suffering. Some regions, like the euro, are suffering more than others. So you have to ask yourself, if you're a long-term trader in foreign currencies and you want to catch a long-term trend, is there going to be a shining star? Is it going to be the United States dollar that you just saw rallies when equity markets suffer? So if equity markets continue to suffer and go down, and the euro region continues to go through this volatile period and suffer, then obviously you would probably want to take a short position in the euro US dollar and be prepared hopefully for it to go down. But if you're wrong, no guarantees out there, have your stops in place and get out. So we know the long-term trend has been down the euro US dollar, but that could change. We will see. So the question I have for you is, do you see one, for you longer-term guys in the Forex markets, do you see a currency that's stronger than others? The Australian dollar was doing very, very, very well, but it got hit very, very hard because it was so dependent on the world's thirst for these commodities that country has. So you have to pay attention to the fundamentals out there that relate to all the markets, but also obviously to which currency pairs you're trading, and know them very well. Have your watch list, pay attention to it, and be proactive, and use your analysis to get in at hopefully good levels and manage the trade, and then exit as you see realistically, that your trading objective has been achieved. But I don't know if there's going to be a shining star going forward. It does seem, though, that other regions of the world are suffering a little bit more than the United States, and as you've seen, the equity markets roll off around the world, the United States dollar does strengthen. So we'll have to see if the United States dollar actually becomes somewhat of a shining star or the stronger currency out there. All right, so let's switch right here, and let's go back into the foreign currency markets, all right, and kind of start there. I'm not going to go into the equity markets. I've already said it. We're very close to our highs. If there's more QE, if people are forced to get into the equity markets because that's where the good returns are, then longer term, because they can't get into bonds or anywhere else, then obviously we have a very good chance of taking out our highs, and that's good for as we've seen, that's good for most currencies against the United States dollar, bad for the US dollar. That's what may happen if the equity markets continue to go higher. We'll see if that's the case. It's just a matter of, relative speaking, which currency really does, rally hard against the US dollar if that's the case. Some may rally more than others. That would be the shining star then in that longer term trend. All right, I'm just checking back to see if there's any questions. All right, what is happening with the US yen? What is happening with the US yen? All right, so the US yen, so I'm just going to kind of take a second and write these down as you guys were asking, so thank you for asking questions. So the US yen, we can take a look at. We didn't look at that before. Swiss National Bank has a very powerful influence on the Euro Swissy. How come? Why is the Euro Swiss franc flat all the time? Okay, we can talk about that. Because that is one of the majors. That's the one we looked at, and we'll look at it again. Do you think that the U.S. Supreme Court ruling on healthcare will affect the Forex market? It's very, very hard to say. Some people don't like my answers when they ask questions. So I'm a very, very, I deal with things as they happen. And so a lot of people will ask me, well, what's going to happen if the Democrats win or the Republicans win? I kind of have my big theories, but that's so far away that I can't worry about that. Now, even if you're a long-term trader in Forex, you're probably not a long-term trader in Forex for 8 or 9 or 10 months. Something's going to happen to get you to your gain, your stop before that happens. So it's very hard to put out a trade for the next 8 or 9 months saying, oh, the Democrats are going to win, or oh, the Republicans are going to win. So I don't think that far ahead. As things happen, and hopefully they're volatile and they provide trading opportunities, then I react to them. Again, if I'm looking to hedge because I hold a portfolio that of equities that could go down in reaction to some of these things like the Supreme Court, decision on healthcare and things like that, then obviously I have to make a decision to say I'm willing to put X amount of my portfolio into a defensive trade, and something's going to happen. My defensive trade's either going to make or lose money, or my portfolio is going to make or lose money, or both. I don't know what's going to happen, but I just have to decide and say I'm willing to do this because I feel like it's the right thing at that time. So I don't know what it's really going to do to the Forex markets. I think the better question is, as you're seeing these relationships, what does it do to the equity markets? And then you understand maybe that if the equity markets do this, the Forex markets should be doing that. If the equity markets do that, the equity markets or the Forex markets are doing this. So use it in relationship and context to what is it doing to all of the markets and see what's happening, and then you can kind of see which way it's going. But again, we don't know what's going to happen in the future, but as we've seen, as equity markets have underperformed, as economic data has underperformed, the U.S. dollar has outperformed. So if you think that the Supreme Court ruling is going to be a bearish event for the equity markets, then you might decide to say, I'm going to buy the United States dollar. Again, no guarantees. That's a trading plan. That's for educational purposes tonight, not a buy, hold, or sell recommendation. It's just for conversation purposes tonight to answer the question, and that might have been your trade, and you have to manage it. If it's going to be a trade for the next 2 minutes, 5 minutes, 5 days, or 5 years, you have to decide how much to risk, how much you're going to try and make, and manage the trade. So hopefully that answered that question on that. Use the overall markets to build your trading plans. That's what I'm trying to get across to you guys. So someone wanted to look at the U.S. yen, so I'm just going to pull that up right here. All right. So what is going on with the U.S. yen? You guys tell me what's going on with the U.S. yen. All right. Equity markets have underperformed for the most of this quarter, May and then early June. And the United States dollar weakened against the yen. And then all of a sudden, the United States dollar started to strengthen against the yen. So equity markets down, the yen strengthened, equity markets up, the yen weakened. So the yen is kind of like the super currency, if you will, out there, where somewhat in times of distress, the yen has actually strengthened against the U.S. And we know that the U.S. strengthens against most currencies when there's times of distress. And here you have the yen beating out the U.S. dollar in times of distress. So there's that intermarket relationship. Over the past couple weeks, again, as the equity markets have rebounded up, the U.S. markets have rebounded up a little bit. So this kind of is going with the equity markets, and the U.S. dollar against the yen are going in the same direction. Equity markets up, U.S. dollar has been going up. Equity markets down, U.S. dollar down. The past couple week equity markets have come back up, so has the U.S. dollar. There's a rough relationship looking at it, so hopefully that answers your question. Someone asked about the yen. About the Swiss franc, the U.S. Swiss franc. Look, guys, I did a webinar a couple weeks ago on the volatility indicator. You guys just have to know that the U.S. yen is just not the U.S. Swiss franc is just not a super volatile currency, and it's still tradable, but you just have to use it realistically. The trading ranges on a daily basis are pretty small. I mean, today you can see we are moving. Let's just look at today. So here's the 27th of June. All right, Tuesday here in America, Wednesday someplace in other areas, and you're looking at 96.50 at the top, and again, today wasn't a super volatile day, and you're looking at 96 even on the bottom, 50 pips. That's 50 pips in 24 hours. You're not trading for 24 hours, you're trading for a little bit. When was the busiest time? Right here, around midnight. 1 o'clock, 2 o'clock, 3 o'clock in the afternoon. Europe time, so this is GMT time, 12 o'clock p.m., 1 o'clock p.m., 1300, 1400, 1500 Army time. So again, most of the volume goes through when the European markets close, American markets open. The U.S. equity markets open right here between 1300 and 1400. So that's where your biggest bars were, right there. Okay, so just be cognizant of that if you're trading this. It is kind of, not boring, but it is somewhat of a boring pair out there. Overall, the United States dollar has been stronger and going up against it over the past year, you could say. But, you just have to take it depending on what type of trader you are and what you're using it for. You have to be realistic. Use the trading plans to tell you what's going on. I told you I'd talk about the euro. I wrote an article about it that I'll show you the link to this week. Is this a dead cat bounce? Is it going to continue to suffer and go down? As far as I'm concerned, the lowest support that it got to is 22.96, so around 23 even, 1.23, and that's just a key level. I don't know what it's going to do there, but I just have that marked in my head. If it breaks that, then it could go in obviously 121, 120, 119, 118, but as far as I'm concerned right now, it's kind of just going sideways. It's made a big move down, a small retracement up 38%, and it's working its way back down. You have to decide, are you bearish? Are you going to force it through its lows? Are you going to trade it short here? Or would you rather have been short up here? You know, what is your goal? How long are you going to be trading it for? Why are you trading it short? You know, what are you trying to achieve out of it? So we don't know what's going to happen, but obviously we know the trend as of late has been the euro has been down against the United States dollar. What about the pound US dollar? Same thing, big move down, and look at this support level. Look, guys, look back over time. 1.53. It bounced here in October of 2011. It bounced here in January of 2012. It bounced here just in the beginning of June. So as far as I'm concerned, that's very strong support. I have no idea what it means. I don't know if it's going to hold the next time it gets there, but as far as I'm concerned, that's a support level. That's just a key number in my head, and as of recent data, it bounced off of a resistance area up here at the 50% level, so we're right in the middle. We're right here. We're kind of dead in the middle of the bottom here, and the top here, this recent high right here, and so I have to make a decision. Am I going to trade here in the middle? Am I trading here in the middle for the next 2 minutes? Am I trading here in the middle for the next 2 days or 5 days or 2 months? What am I trying to achieve? What's my risk reward? What's my trading plan? All right? But at least you know where it is based on recent data. It doesn't tell us where it's going. We just have an understanding of, do we want to enter it here? Do we want to wait for it to get support? Do we want to wait for it to get to resistance? Why did it get to support? And do we want to trade it down there? So remember, you're going to learn something each and every single day. Let that update your plan. Just because it got back to support where it bounced last time doesn't mean I'm going to trade it. If the equity markets are going down, 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 and I think that that's bad for the pound and good for the dollar, I'm not going to, maybe I won't buy the pound at that time. If it gets down there at support and the pound is down there and the equity markets are hanging in there and not doing too badly, maybe you use that as a support level. Every day will give you new information to update your trading plan. All right? So that's my hypothesis going forward, is be very careful of these news events. Pay attention to the news. Pay attention to the wires and these news bombs or rumorville, and use those market relationships to get you into trading plans that you feel have good risk reward built into them, and continue to manage them. That's the key, okay? That's the key, is just managing your trades. Let's see if there's another questions. Or question. Do you trade the Euro, US dollar, and US Swissy at the same time with the other markets? Like I said, I'm a day trader, and I use them in longer term. So sometimes I'm trading both of them because they're active. Sometimes I'm trading the Swiss against US dollar. Sometimes I'm trading the euro. It just depends on what I'm trying to achieve. But for the most part, when I'm actively trading, when I'm looking for scalp and swing opportunities, I'm trading that busy time. I'm trading the kind of 9 to noon, 9 to 1, 9 to 2 period New York time. All right, so you can figure out where you are in the world from there. But 9 to 2 is kind of a sweet spot. 9 a.m. to 2 p.m. is kind of a sweet spot. Again, I live in America. I don't have the choice of being up 24 hours a day. There are very busy times during the European Open, you know, which is midnight, 1 o'clock, 2 o'clock my time, but I'm sleeping then. I'm not trading 24 hours a day. So if you're living in Europe, you're probably trading the European Open and maybe into the European close. All depends on where you're at. So just make sure you're being realistic to who you are as a trader, and that's something here that I provide for you guys. If you don't understand what you should be achieving and what's realistic for you, I provide these engagement interviews, and I do them for all of the people here that listen in on IBFX. I'm very, very big on you being the system. Until you understand what's realistic for your individual situation, I feel like it's hard to approach these markets and be profitable in them, you know, and not just profitable, but be successful in them, because profitable is really the wrong word. It's just have a good chance of success. So I want you to understand who you are, and I provide these 30-minute interviews via Skype or on the phone. You can email me to set them up. They're free. They're no obligation. I do have a consulting company where I work with individuals all around the world, teaching them to trade, invest, and things like that, and read the markets fundamentally and technically and focus on these intermarket relationships and trading edges. But if you're not grounded, if you don't know what's realistic for you, when you should be trading, what time you should be trading, what time frame you should be trading, how many pips to risk for your account and things like that, that's something that I give you in that interview opportunity. So again, take advantage of it. It's free. It's no obligation. It takes about 30 minutes. You can email me and set that up. And basically, I just call it grounding. You get grounded. It's 30 minutes where you get my unbiased opinion. I shoot straight. You may not like what I hear, but I'll be very honest. You'll tell me your situation, and I'll just type it up and send it to you in a Word document, and there you have Jupiter Peak Financial's consulting company's opinion of your situation. So to review, we talked about what's happened in the past with quarter two fundamentals and technicals. We looked ahead at quarter three fundamentals of what I think is going to happen. And then we looked at a few pairs as far as the technicals. And based on what we've been seeing in the past in quarter two, can you start to make some trading decisions or trading plans if things start to happen? Think of it as a flow chart. If this happens, I'm doing this. If that happens, I'm doing that. No guarantees. I'm not over leveraging my account. I'm managing it with stops and targets. I'm always setting that in, before obviously I choose to actually go into the markets or leave anything open and turn off my computer. So next webinar will be 2 weeks from now. Same thing. We'll talk about some fundamental analysis. We'll do technical analysis. The main topic will be using trends to enter trades, taking advantage of trends, whether it's short-term or long-term. We'll be using trends to enter the trades. Actually, both July webinars, I do them every 2 weeks. The July webinar 2 weeks from now will set up the July webinar 4 weeks from now. They're going to follow up on each other. So it's going to use trends to enter trades, and then we'll build on that for the webinar 4 weeks from now. Great education at IBFX. So that's your link to the education site. Just go onto IBFX and find the education tab. I write about 4 days a week on the Daily Forex Trading Edge page. And again, I wrote a lot on the Euro US dollar because it's been trading really, really nicely this past week and providing some good opportunities and good volatility. So dailyforextradingedge.com, and you can just go there, and I write there. Again, I write articles probably about 4 days every single week. I do have my own blog where I write, but it's the same exact information you find on Daily Forex Trading Edge. It's at Finance Banter. But just go to Daily Forex Trading Edge and start reading through my past articles. There's already 2 this week that are posted there. These webinars are going to be recorded. I have about 22 videos on the YouTube site, so you can just go to YouTube, and then you can just go and search for Interbank FX videos. My commentary, because I believe that this is where we're going in the future, my webinars are all titled Trading in the New Economy, because I think this is going to be a new economy for you traders, for you investors going forward. So I'm approaching it differently than I was 5 years ago or 6 years ago or 10 years ago. I think it's going to be a lot of political events involved in the markets, and we have to stay on top of that. So my webinar series, 22 videos there, Trading in the New Economy. And then I post every day. I posted today looking at trading opportunities, some in the pound and some in the euro. I post on the Connect site, so it's kind of the social site. So please follow me there, the IBFX Connect site, and my name is The Locals Take. You can find me there and follow me there. Let me just check back and see if there's any questions as we get ready to wrap up. Let's see. I think we have a few follow-up questions. So someone was just writing that they don't care about the news on the TV because I think if I'm reading it right, it drives the markets just for a little bit, and then the markets do what they want for the most part. I agree in some ways. I don't know what you're listening to. I think you should be very, very wary of what you're listening to and what you're reading to. But if you just followed, I'm not saying you pay attention to everything out there. If you followed the facts, the economic data on the economic calendar over the past 12 weeks, you wouldn't be surprised that the equity markets went down. And then if you saw that relationship with the Forex markets and saw what do poor equity markets do to the United States dollar, okay, it's strengthening it, well then that might not cause you then to go against that trend, you know what I mean, or be very wary of going against that trend and doing it in good locations. But at least you understood that relationship. And again, that relationship can help you maybe in the future. Who knows? But that's what I'm talking about, is just paying attention to factual data. I'm not talking about going on TV and saying, this guy's talking about that guy's providing his analysis, because remember, CNBC, what are they in the business of? They're in the business of selling advertising, and they do it very, very, very well. They don't know who you are. You need to filter all of that news. But the factual data, what's coming out in the economic calendar, that's factual. What did the traders do with it? The traders, what did they do with it? They sold the crap out of the equity markets in the month of May. They sold off almost every currency against the US dollar there, except for as we looked at the Japanese yen. But that's what I'm talking about. Use the factual data to help you build trading plans. So hopefully that makes sense. So I believe that you need to use the news, and you need to use TV, but you need to use it for your situation and filter it. And that's what comes back to that engagement interview, is if you don't know how to use it, that's what I can help you with. I think you need to be very, very wary of what you're listening to. I agree. And some people need to be more wary of others. It all depends on their trading account size and their risk tolerance and what they're trying to achieve. Different people are paying attention to different things. Some people are just Forex traders. Some people are managing lots and lots of money in an estate, in equity markets, and their retirement accounts and things like that. And maybe they own a lot of a stock like Apple or something like that. Then they can use the trade station that I mentioned, or they should be paying attention to things like that. So again, every single person is different out there. You've got to know what to pay attention to for you. So hopefully that that helps with that answer. What do you think? So I think let's see if I answered that on the news. We don't know the market moves up or down, so I prefer to open 2 positions at top of current value and down the current value. So you can just how many pips should take the positions, let's say. I don't think I'm understanding the question. I think I'll hold off on that one because it might be a specific strategy to you that you're doing. So you're welcome to email me on that one if you want me to comment on that, because it sounds like it's something that you're doing, and hopefully it's a good strategy and hopefully it's working. But me personally, I'm a directional trader. I say I think this is happening and I'm going to take this position short or long. If you're taking dual positions and going short and long because you don't know what's happening, that can be a very bad place to be, because obviously one position might be offsetting the other, and so hopefully it's working out, but you're dealing with more, more contracts on, and you have more open positions and things like that. And in volatile markets, you just have to be careful of that. So just be wary of the more things you have going on. Just make sure that you can manage it for your trading situation. So thank you guys very, very, very much. Again, I'll just click back up here to provide my email if you have any questions. I look forward to seeing you in 2 weeks. Please read my daily market commentary. Please take advantage of IBFX's Connect, their social trading site, and follow me there. And have a great third quarter. Thank you very much.